Have you ever watched a market that seems coiled, held down by invisible forces for years, and wondered what it would take for it to finally break free? For a long time, that was the story of silver. It was a story of containment, of potential that was always just around the corner. But then, in late 2025, something didn't just bend, it broke. Suddenly, all of that pent-up energy was unleashed in a massive, explosive move. Today, we're going to dissect exactly how that happened. We're going to look at the anatomy of this great escape, exploring the two powerful opposing forces that finally collided and set silver free. Welcome to the Bullion Signal Podcast, the channel where we look at the macro trends, the precious metals, and the strategies you need to protect and grow your wealth in an uncertain world. If you find this analysis valuable, make sure you hit that subscribe button so you don't miss our future episodes. Let's get into it.
Everything, and I mean everything we're about to discuss, really boils down to this one single idea. This quote gets to the heart of the matter. It's about the moment the market as a whole looks around and has a collective realization that the central banks, they can't stop. They can't step back. The system is so fragile that it now requires permanent, constant life support. That single realization was the spark. It was the fundamental catalyst that lit the fuse for everything that was about to happen.
So, let's talk about the first of our two major forces. This was the one that came out of nowhere with incredible speed and force. It was a complete 180 from the U.S. Federal Reserve. Now, you have to understand, they weren't just gently tapping the brakes or slightly changing course. No, this was a full-blown emergency maneuver. They slammed the brakes on their old policy of tightening, and then they floored the accelerator in the complete opposite direction. What they unleashed can really only be described as a monetary tsunami. And just look at the timeline here. The speed of this pivot is what should really get your attention. On December 1st, they abruptly halt their quantitative tightening program. That alone is big news. But then, just 9 days later, they hit the market with a surprise third interest rate cut for the year. And before anyone can even process that, 2 days later, they announce a brand new program to start buying up government debt again. Think about that. In less than 2 weeks, the entire narrative shifted from "we're fighting inflation" to "we're opening the floodgates." That kind of policy whiplash, it just screams that they're seeing something behind the curtain that has them deeply, deeply concerned.
And this number? This was the real game changer. This was the moment of truth. The Fed officially committed to creating $40 billion new dollars out of thin air every single month to buy government bonds. Let's put that in perspective. That's almost $500 billion a year in new money. It's like turning on a massive fire hose of liquidity and aiming it directly at the heart of the financial system. It was a complete and total reversal of everything they'd been saying they were going to do.
And here's where the communication game gets really interesting. The Fed, of course, was very careful with their language. They insisted on calling this a technical intervention. They tried to assure everyone it wasn't the same as what they did before. But here's the thing. The market doesn't care about labels. The market cares about reality. And the reality is when you are creating new currency to buy up debt, that's quantitative easing. You can call it QE5, you can call it a technical adjustment, you can call it whatever you want. The result is exactly the same. The supply of currency is expanding, and it's expanding fast. So why does all this matter? Well, it all comes down to this concept of real yields. It's a simple idea, really. It's just the return you get on an investment after you subtract the rate of inflation. And what the Fed's actions did was push these real yields deep into negative territory. In plain English, that means that holding your money in cash or in so-called safe government bonds was now a guaranteed way to lose purchasing power. Your money was actively being devalued. When that happens, smart money doesn't just sit there and watch it melt. It's forced to flee. It has to seek refuge in real assets, assets that can't be printed out of thin air. Okay, so that was force number one, the monetary fuel. Now let's look at force number two. You see, this monetary tsunami wasn't just poured onto an open field. It was poured onto a tinderbox that was already bone dry and ready to ignite. And that tinderbox was the physical silver market, which for years had been suffering from a deep, prolonged structural deficit. Just take a look at this. It's pretty stark. For 5
count them, 5 consecutive years, the world consumed more physical silver than was mined and recycled. This wasn't a one-time thing, it wasn't a blip on the radar. This was a deep structural problem. Year after year, the world was eating into its existing stockpiles of silver. And that process was draining available inventories, building up an incredible amount of tension just below the surface of the market.
And we're not talking about a small rounding error here. The physical shortfall in 2025 alone was over 200 million ounces. That's a massive gap between supply and demand. This relentless year-after-year deficit meant that the amount of available silver, the actual metal ready for delivery, was getting tighter and tighter and tighter, long before the Fed ever decided to pivot. The stage was already set.
So what was causing this huge deficit? This chart tells you almost everything you need to know. A massive 60% of all silver demand comes from industry. Now, this is what makes silver so different from its cousin gold. With gold, most of the demand is for investment or jewelry. It sits in a vault. But silver gets used up. It's consumed in manufacturing processes and becomes a permanent, non-recoverable part of our technology. This makes its demand incredibly sticky.
And what kind of technology are we talking about? Well, it's pretty much the backbone of the entire modern world. Solar panels, electric vehicles, every smartphone and laptop, the 5G infrastructure that connects all of us, they all absolutely require silver to function. And for most of these critical applications, there are simply no viable substitutes. This means the industrial demand is what economists call price inelastic. The industries have to buy it. Whether the price is $20 or $200, they need the metal to build their products. The demand is not optional.
And this is where the two powerful forces finally collide. On one side, you have a central bank in a panic, hitting the emergency button and promising to flood the world with newly created currency. And on the other side, you have a physical commodity market that's already strained to the breaking point by years and years of deep deficits. This was the moment of ignition. This is when the monetary fuel hit the physical tinderbox.
The reaction in the wider market was instantaneous and, frankly, completely predictable. The US dollar index, which measures the strength of the dollar against other major world currencies, absolutely plunged. The moment the Fed announced more money printing and more rate cuts, it was a clear signal that the value of the currency was going to be diluted.
And as the dollar took a nosedive, silver did the exact opposite. It didn't just go up, it exploded upward. Putting these two charts side by side tells the whole story. It's a perfect visualization of cause and effect. A rapidly weakening currency sent investors all over the world scrambling for the safety of a real, tangible, hard asset, and silver was right there waiting. But what happened here was more than just numbers on a screen. The truly important thing was the psychological shift that took place. The Fed's sudden pivot was seen by many as a public admission that the system was in serious trouble, and that changed the game completely. In the minds of investors, silver transformed. It was no longer viewed as just an industrial commodity. It was now seen for what it also is, an essential monetary hedge. It became a lifeboat in a currency storm.
This fundamental psychological shift has ushered in a new era for investors. The primary goal is no longer simply chasing the highest return. For many, it's now become a desperate search for real, tangible value. The game is now about wealth preservation, in a world where currencies are actively being devalued by the very institutions that are supposed to protect them. It's a whole new paradigm.
The data from back in December 2025 really reveals just how much potential was coiled up. You had gold at over $4,000 and silver at just under 63. Now look at that gold to silver ratio. It was at 67 to 1. That means it took 67 ounces of silver to buy just 1 ounce of gold. For anyone who follows this market, you know that historically that is an extremely high number, signaling that silver was deeply undervalued relative to gold.
And here's why that ratio is so important. Historically, the long-term average is closer to 50 to 1. But in past bull markets for precious metals, we have seen this ratio compress dramatically, sometimes falling towards 25 to 1 or even lower. If the ratio were to simply begin normalizing from 67 down toward that historic breakout target, it would imply a silver price well into the triple digits, even if gold's price went nowhere. It highlights just how much catching up silver had to do.
And here's the point I really want you to take away from all this. This entire move has an incredibly strong foundation under it. This isn't just about paper contracts being traded back and forth on an exchange. The price is being fundamentally supported by a real, tangible, physical shortage of the metal. That 5-year deficit, that's not speculation. That's a fact, and it provides an incredibly solid floor under this market, making this move fundamentally different from so many others.
So this incredible collision of forces, the monetary and the physical, it leaves us all with one ultimate question. On one hand, you have central banks with the power to create currency infinitely, with just a few keystrokes. And on the other, you have a critical commodity, essential for our future, with a supply that has been starved for half a decade. It forces every single one of us to step back and ask a very fundamental question. When the money we use can be created without limit, what is the true measure of value? That's the question for our time. And that's the core of what we explore here at Bullion Signal. Thank you for tuning in today. If this explainer helped you connect the dots, please hit the like button, share it with someone you think would benefit, and be sure to subscribe to the Bullion Signal Podcast for more insights. We'll see you in the next episode. Finally, a quick disclaimer. The content in this podcast is for informational and educational purposes only. It is not and should not be construed as financial or investment advice. You should always conduct your own research and consult with a professional before making any investment decisions. You are solely responsible for the actions you take.